So, Ed, what's at stake here, not just for the candidates, but also for the markets who are really seeing this field narrow very, very quickly?
Rochelle, that's a great question because what we found at Raymond James is that very frequently in presidential election years, the market is weak until the parties choose their nominee. Oftentimes, that is through Super Tuesday, which is the beginning of March. One of the questions we have is that if New Hampshire is a decisive victory for Donald Trump, is the market starting to sense that some of the uncertainty that primary season can bring is providing greater certainty in the matchup between Donald Trump and Joe Biden, a repeat of 2020, is in the cards for November of this year.
Is the calculation for that political risk, though, Ed, a little different this time around? Let's say tonight the former president does come out on top, and yet this isn't somebody that voters are not familiar with. He's not necessarily an incumbent, but somebody who was in the White House. From a market perspective, does that risk change as a result, knowing what we know already about what a Trump presidency could look like?
Yeah, Kiko, I think that the question that I've been getting a lot from investors that I talk to here at Raymond James has been how much of this would be a referendum on Joe Biden, the incumbent. Normally, elections are referendums on the incumbent, or because voters know Donald Trump as well as they do, is it ultimately a referendum on Donald Trump? When we look at the policies post-election, the first thing that we're going to have to encounter is the debt limit. We had a major market volatility when we were dealing with that back in 2022. We will also be looking at the expiration of the tax cuts that President Trump did in 2017 in December of next year. The winner of this election is going to dictate that debate. How much of those tax cuts get extended? How much of those get changed? That's a $4 trillion question at a time where the debt and the deficit is becoming more part of the conversation. So there will be a major kind of election impact on the markets, even if we do settle on who the candidates will be here, Kiko.
So then, Ed, as you mentioned there, the tax cuts, and as we've heard on the campaign trail, former President Trump intending to have even deeper tax cuts as well. But then when you think of the US debt, when you think of the deficit as well, how does that bode for markets? Do they have a preference for Biden versus Trump?
Well, Rochelle, I think that there is generally, from a market perspective, a desire to have certainty. I think when we look at the tax cuts, the corporate side of the tax cuts are viewed as permanent. The individual side is what's up for debate. If we do have a Democratic president, if Joe Biden is reelected, I think the conversation in 2025 is about the entire tax code. That adds some level of uncertainty, but we have to peel a little bit deeper to think about what does that mean for SALT. That has really made a huge move from California, New York, other high tax states into low tax states. Is there a preference depending upon what parts of the economy benefit versus a kind of across the board extension? There is a growing concern in the market about what it does for the long-term debt and deficit. We saw late last year a 5% yield on the 10-year. Certainly markets had a negative reaction to that. So there's not a clear cut, this is good, this is bad. It's more of let's talk about what the outcome is and apply it to different sectors that get those impacts greater rather than others that don't see as much of those impacts.
What about those sectors that have been big beneficiaries of Biden policies? We're talking specifically about some of those green stock sustainability names, as well as those that have been beneficiaries on the back of the CHIPS Act. I realize we're talking in January. The election is not until November. But how do you look at the implications there and the potential of a Biden loss?
So I think that the sentiment on things like the repeal of the Inflation Reduction Act is going to be much greater than the reality. When I talk to Republicans on Capitol Hill, what they tell me is the repeal of the Inflation Reduction Act, the IRA, Obamacare 2.0, something that they run on. But when the votes occur, are the votes going to be there to repeal it? Especially since so many of these projects are in Republican congressional districts, in Republican states that are represented by Republican senators. When you think about the CHIPS and Science Act, that was overwhelmingly bipartisan. But what I've been telling clients here at Raymond James is that CHIPS and Science Act, the IRA, even the infrastructure bill are part of the hidden stimulus in the market. it might seem like old news to talk about some of those things, or it might be fun or sexy to talk about the potential repeal. But the economic reality for 2024 is most of that money, while it had passed years ago, is just about to hit the market. Chips and Science Act, $54 billion worth of grants. Less than 200 million has gone out the door. We're going to see a lot of that go out the door this year. And one of the questions I have for clients is that part of a soft landing scenario? A lot of the hidden fiscal stimulus passed at the height of the economic cycle coming in during an election year. That's where I get the most questions.
And Ed, you raise an interesting point. Obviously, we are still expecting a lot of volatility until we get some more certainty from the Fed. Do voters tend to look at some of this volatility, since your average American is mostly invested in the market through their 401ks? Do they tend to correlate that with how they feel about the candidate that they're voting for?
So, Rochelle, there are times where in election years when there's a big part of volatility, people move more into cash. Now, we're actually looking at, because we're paying savers for the first time in 20 years, a lot of money in money market funds. Does that stay in there longer? Is there kind of a greater risk for staying on the sideline? In presidential election years, on average, the market's up. When we've had that volatility, usually that's frequently corrected as soon as we have some level of certainty. And what's really important for investors to know is that the year after a presidential election is usually the best year of a 4-year cycle. So we don't think that the election is a reason to stay on sidelines or stay in cash. In reality, it's usually an opportunity to use some of those areas of volatility to dip your toe back in, dollar cost average back into this market. Ultimately, we do sometimes use elections or kind of our political candidates to cloud our view, but that is usually a way of losing money rather than making money, especially in the long term for this market.
Yeah, some really good takeaways there, Ed. Always good to get your insight. Ed Mills, Raymond James, Managing Director. Good to talk to you today. Appreciate the time.
Thank you, Akiko.